Later CPA and Associates, accounting done great by mates.
Hi there. I'm Daniel Lader, founder of Lader CPA and Associates, and welcome back to our ongoing series, the 20-Week Tax Strategy Readiness Roadmap. You can get your firm ready with the best tax strategies. This week, we're talking about getting your estimated taxes under control. Estimated taxes should not feel like a surprise bill that appears 4 times a year. For many private practice owners, the real problem is not paying the tax. The problem is not knowing how much to save, when payments are due, when the payment amount is still accurate, and whether enough cash will be available. A simple system can make estimated taxes much more predictable. Now, employees normally have their taxes withheld from every paycheck, but business owners may receive income without enough taxes being withheld. Estimated payments are how they pay federal income tax and, when applicable, self-employment taxes during the year. You may need to make estimated payments when you have income coming from a sole proprietor, partnership income, S corporation profits, contract work, investments or rental properties, or a spouse's income when they don't have enough withholding. Estimated taxes are personal tax payments. They are generally not a business expense. Now, federal estimated tax payments are generally due 4 times every year: April 15th, June 15th, September 15th, and January 15th of the following year. These dates are not spaced exactly 3 months apart, so they can be really easy to miss. State estimated tax deadlines may be similar, but each state has its own rules. Put every deadline on your calendar at the beginning of the year. Now, to pay estimated taxes, some owners automatically save 20%, 25%, or 30% of every deposit. That can be a really useful starting point, but it's not a complete tax plan. Your actual tax plan depends on the business's profits, not just the revenues, your spouse's income, your other payroll withholdings, your filing status, any tax credits or deductions you'll get, any retirement contributions, other income for your household, and what your state income taxes are doing. A percentage that worked last year for your automatic savings may not work again this year. So create a separate savings account that you use only for taxes. Every time your practice receives income, transfer your planned tax percentage into that account, leave the money in that tax account, and pay your estimates from that account. Do not treat that balance as available spending money. This separates your tax money from operating cash and reduces the chance that it will be spent accidentally. During the year, review your estimated taxes. Do not calculate estimated taxes once and then ignore them. Review your tax projection. When your revenue increases or decreases, you hire another therapist, your expenses change, your spouse changes jobs, you start payroll, you make a large retirement contribution, you move to another state, or you have another major financial change. And remember, just run projections periodically through the year to see how the year is doing. A projection should use current bookkeeping and year-to-date income. Without accurate numbers, the estimate is only a guess. Now, the goal of estimated payments is not always to pay the exact final tax liability. One option is to pay just enough during the year to reduce or avoid any underpayment penalties. Now, most taxpayers generally can avoid the federal penalty, underpayment penalty, by paying at least the smaller of 90% of this year's tax, or 100% of last year's tax amount. The prior year amount generally increases to 110% for certain high-income taxpayers, but for most of us, think of it as 100%. You may also avoid the penalty when any remaining balance due by April 15th is less than $1,000. Safe harbor can prevent a penalty, but it does not guarantee that you will not owe money when the tax return is filed. So, take control by setting up a simple system to get your estimated taxes under control, keep your bookkeeping current, maintain a separate tax savings account, transfer money throughout the month, schedule every payment deadline, review your tax projection during the year, adjust payments when your income changes, and plan for both federal and state taxes. Now, in closing, your estimated taxes become stressful when they're treated as 4 unexpected bills, but they become manageable when taxes are built into the normal cash flow of the practice. The goal is not just to make payments on time. The goal is to know what you are likely to owe, have the money ready, and avoid a major surprise when the tax return is filed. Next week, we will be talking about understanding your business structure. So don't forget to like, follow, and subscribe for future events and tax advice. Visit our website, latercpa.com. Have a great weekend. Keep helping others to help themselves, and let us help you to do just that. I'll see you next time. Bye.
For all your tax needs and